Hello, dear students. In security analysis and portfolio management, now we are going to discuss about risk and return concept. Basically, when we are investing in any assets, two things that we need to incur, that is, one is risk. Yes, obviously risk is involved. Like when we are taking any finance related activity, when we are involved in any finance related activity, risk is obviously involved. And why we are into that field, why we are into, why we are taking that kind of role is something that after a certain period of time we have to gain some profit. That is what the return. Let us understand about risk and return. First, risk. So risk is defined as a variability in return or volatility in return. See, without risk, probably that risk ratio might differ from one investment to another investment, but definitely for sure, in risk is what there in every investments. Okay, so like it is the chance of actual return being less than the expected return. So there are two kinds of return. One is actual, another one is expected. See, expected return is what the return that what we expect from the investment that where we invested for. Okay, say for example, if you are invested in shares, you may expect certain kind of dividend from the so and so company, but the actuals that what you received from the company, it may differ. So that is what, if the expected return is not achieved by you, it is not gained by you, obviously that comes under the category of risk. Okay, next. So what different types of risk? One is systematic, another one is unsystematic. So let us discuss this systematic. So systematic risk, basically it comes under market risk, interest rate risk, and then purchasing power risk. See, these kind of risks actually like which we can able to control. We have some control. See, market risk, interest rate risk, purchasing power risk. So these are all the different kinds of risk. See, obviously interest rate. Sometimes interest rate, it may be 5% or 7 or 9. Like that variations it may happens. Market risk. We cannot predict what is going to happen in the market. Next is purchasing power risk. Okay, purchasing power is something that today we are purchasing any product for rupees 100. For the next year, the same product will not be available for the same 100 rupees. Okay, so it may increase up to like 120 or 110, whatever. Okay, so next is what? Unsystematic risk. Why it is happening? Unsystematic risk. See, because of the certain reasons like financial leverages, managerial inefficiency, technological risk, production process, availability of raw material, changes consumer preferences, and labor problems. See, all these unsystematic risk, it is what happening because that how you are running your organization. Okay, so based on that, these kind of risks happen. Whereas systematic risk, you cannot able to do anything. You are not in a position to do anything, right? So that is why it is called as like it is not controlled and it is not under the control of you as a person, as you. Okay, whereas unsystematic risk, see, availability of raw material, it depends upon the actual person who is running the business. Okay, inefficiency. So all these things, technological change in the production process, if you're not implementing technological change, it may happen. Okay, so business risk is the difference between revenue and the EBIT. EBIT is nothing but earnings before interest and taxes. Financial risk, so where it refers it is what the difference between EBIT and the EBT. So EBT is nothing but earnings before tax. Okay, next. Yes. So what is a return? So we discussed about risk. Return is nothing but the investment, from the investment, what income that you are gaining. Okay, that is basically called as return. So we say this return as yields or else capital gains. Okay, yields. We also say this return as yields. What kind of return that we are gaining? Capital appreciation. That is what are written capital gain. Yeah. Thank you.